Hello, everyone. Trust your day is going well. We are doing a beginner's guide to investments. This is just essentially to do an introduction so that everyone understands and sees what it is that we're trying to do here. Okay, so the first thing that we'll talk through about is the introduction. Then we'll talk about stocks, equity, or you can sometimes they're called equities, bonds, or fixed income in this instance, pooled investments such as mutual funds, ETFs, and other vehicles. Commodities. Commodities also mean like your oil, your metals, or your grains. And we'll also discuss alternative investments with a short note on cryptocurrency. So let's start with our introduction. An investment is an asset or instrument acquired with the goal of generating an income or increased values. So these assets sometimes can be financial or physical. It could even be a code in a blockchain. So financial assets are non-physical assets whose value is derived from a claim. Sometimes it could be bonds, or it could even be cash deposits, and even company share capital. There are generally two types of assets, financial assets. You have your stocks and your bonds. Everything else is essentially a derivative of the two. Then you have your alternatives, and then you have your real estate. But the most important thing that we must do before we even start investing is to take care of our housekeeping. Now, first step before you invest is to define your why. Why do you want to invest? What causes are important to you? What lines aren't you willing to cross? What does financial freedom mean to you? What do you want to achieve in the long run? What risks are you willing to take? You're defining your why has to be specific. And after you've defined your why, you need to get your finances in order. Before I go to the next slide, I also need to explain something. Some people like to invest in women-led businesses. That's an example. Some people, due to religious constraints, can only invest in businesses that don't encourage sin, such as no weapons, brothels, gambling, or interest. I've seen people who will state that they shouldn't short sell or include derivatives in their portfolios. And when we are talking about what do you want to achieve in the long run, or when we talk about being specific, we need to also say things like, okay, when I'm 60, I want to have $1 million in my bank account, have a 4-bedroom house in Banana Island, and my children should have graduated from a university abroad. And we also have to bear in mind that sometimes, attaining your goal would possibly mean increasing your income. If you do not sort out your finances before you start investing, you could easily go astray. And the worst thing that could ever happen to anyone is using your investments to sort out emergencies. So the first thing that you will need to do is set up your budget. And that will mean organizing your finances and understanding your debt. And I say understand your debts because some people don't understand. They just take loans. They would take all these credit card loans or payday loans and not really understand what exactly it means to enter such a covenant. Then the next step will be to build your emergency savings. And while you're building your emergency savings, you need to see where you need to cut down, or whether you should increase your income, and also seek ways to accelerate debt payments. So maybe instead of paying the minimum card payment is $50 a month, you could seek ways to say, okay, let me increase it to $80 a month. If I have a side hustle here, I can be using that to pay down the debt, those types of things. Then you now open investment accounts. They need to understand the investments, and you need to research suitable products for you. Not everyone is going to have the same, not everyone is going to have the same risk appetite. Then you start investing, where you can make your purchases and you start monitoring your investments. Earlier, remember that we asked these questions: what risks are you willing to take? And every asset class has its own risk. Sometimes you would hear things like, a risk-free rate. And essentially that is the yield of a government bond. Usually they would use a 10-year government bond. Sometimes people would use a 1-year treasury bill or a 3-month treasury bill. It all depends on the way your market is and how volatile things can get. But even with bonds, even when you're dealing with bonds, they can be very risky. So, and as you see here, we have here our conservative, our moderately conservative, our aggressive, and speculative. So things like crypto, even though people were talking about, oh, crypto is the way to go, it's highly speculative, and it's not something that you put all your portfolios in. And you notice that from the bottom of the pyramid to the top, you're increasing your potential for high returns. I'm sure we are all familiar with the term high risk, high reward. So that is what this is discussing. So obviously the bottom is cash and cash equivalents, insurance. You have your savings bonds and all the likes, all the way to the top. Generally, these are the things I need to bear in mind. Before you start investing, we said we need to understand your risk appetite. I will share the link in the caption below, so you can click on it and click on it and see what your investments or what your risk appetite is. And you should diversify across asset classes, economic sectors, entities. And for some people, they go as far as investing in another country altogether. So they have a very diverse, holding in their portfolio. And all this has to be in accordance with your risk appetite or age. We also need to understand that bonds can just be as volatile as stocks, especially if your intention is to trade. It is impossible to time the markets in the long run to make money. You could do it for a short term, but long term is impossible. You cannot time the market. And another thing is stay invested and harness the magic of compounding. I've put an example here on the screen. A lot of people don't realize this. The more frequently you save or the more frequently you invest, the higher it is. So you've put like 100,000 Naira a month in a year will give you 1.2 million, or you save 25,000 Naira a week, which will give you 1.3 million. And meanwhile, we've not even started adding the interest component to this. So you can imagine what it's going to be. So to talk more about this, you need to understand that when we talk about risk again, if you are a conservative investor, after you've seen your results, you could say something like, okay, I'm going to invest 35% of my portfolio in stocks. For some people, we said that we should talk about age. So you can say that, okay, 100 minus your age would tell you, okay, if I am 40, for example, and I can say that, okay, because I'm 40, 60% of my portfolio can go into equities, while 40% of it will go into bonds. So obviously, as you get older and older, the amount of risky investments will reduce. Sometimes I've seen places where it has actually been modified to use 110 to 120 minus your age, you know. So, but for those in poor nations or poor countries where you don't get to live till you're very old, it's better to just stick with the 100. Then those in developed nations, because of healthcare, you know, you can say that it's 110. This is an example of a diversified portfolio. You can see here, this is essentially a primarily a stock portfolio, you know, and this is actually a real portfolio, the portfolio for this company. And you can see as at this particular date, year-to-date return on the portfolio was 11.5, while the Nigerian Stock Exchange returned 2.8% year-to-date. But if you're talking about from inception of this portfolio, it has returned around 24% compared to almost 4% from the Nigerian Stock Exchange. So this is the end of the introduction. Have a nice day, everyone.